What if the biggest financial revolution of our generation
that when the big guys, including one of your main investors in your company, started to lose, you shut down the game to starve the little guy?
was actually a multi-million-dollar trap designed to harvest your data? In 2013, a Silicon Valley startup completely upended the global stock market with a radical proposition.
The story of Robinhood. Robinhood started 5 years ago by pioneering commission-free, no-account minimum mobile investing.
Democratize finance for all. By completely eliminating the $5 to $10 trading fees charged by legacy Wall Street brokers, they brilliantly disrupted the brokerage market. When Robinhood introduced an easy-to-use and sleek-looking gamified smartphone experience, complete with digital confetti, they convinced millions of everyday people that they were finally playing a fair game against institutional giants. Within a few short years, this single app captured the hearts, the trust, and the bank accounts of an entire generation of novice investors who genuinely believed they were participating in a financial uprising. But they never disclosed the fundamental law of the internet. If you're not paying for the product, you are the product. Millions of retail day traders believed they were outsmarting the system from their phones. In reality, their trading data was being quietly packaged, routed, and sold behind closed doors to the highest bidder. Is Robinhood actually free? To answer that question, you have to peel back the polished consumer interface and look directly into a hidden Wall Street system known as payment for order flow, a highly lucrative corporate mechanism that transformed commission-free investing into a brilliant psychological illusion. The underlying mechanics of a zero-fee brokerage model rely entirely on this hidden pipeline. When a retail investor logs into an app, looks at a chart, and hits the buy button for a volatile asset, common sense dictates that the order travels straight to a public venue like the New York Stock Exchange to find a seller. That is a complete myth. Behind the clean user interface, the app acts as a middleman, auctioning off the execution rights of those retail trades to predatory, high-frequency trading firms, including institutional market makers like Citadel Securities. These Wall Street giants willingly pay hundreds of millions of dollars every single year just for exclusive access to this private retail order stream. Why? Because seeing exactly what millions of retail buyers are about to do, a fraction of a millisecond before it actually happens on the public system, is the ultimate unfair market advantage. It allows institutional algorithms to anticipate retail momentum, adjust their own risk parameters, and trade ahead of the crowd with absolute mathematical certainty. For years, the public was assured that this back-end routing arrangement was entirely harmless to their individual portfolios, claiming it was a win-win scenario for everyone involved. Banking regulators eventually proved that statement was an outright lie. The theoretical dangers of this relationship suddenly mutated into a historic reality in January 2021. This was the moment the zero-fee facade shattered on global television during the unprecedented GameStop short squeeze. A massive online community of retail investors mobilized on the Reddit forum Wall Street Bets, noticing that institutional hedge funds had taken massive, over-leveraged short positions, betting that GameStop would go completely bankrupt. Recognizing a rare structural vulnerability, the millions of members on Wall Street Bets coordinated an aggressive, hyper-concentrated buying campaign. By locking up available shares and driving the price up by thousands of %, they triggered a devastating short squeeze, forcing those multi-billion-dollar hedge funds into catastrophic financial positions as their short bets bled billions of dollars in real time. Now, when you click buy on an app, the cash and shares aren't actually transferred instantly. By federal law, it takes 2 full days for the transaction to clear. Managing this massive multi-billion-dollar waiting room is a central back-end institution called a clearinghouse. Because GameStop's price was swinging wildly, the central clearinghouse grew absolutely terrified that if the stock suddenly crashed to zero during that 2-day waiting period, Robinhood wouldn't have enough money to settle the massive trades their users had just submitted. To protect the system from a massive default, the Central Clearinghouse hit Robinhood with an unprecedented emergency collateral bill on the morning of January 28th, demanding a massive $3 billion deposit before the opening bell, just to allow them to keep processing trades. Robinhood simply did not have $3 billion in liquid cash. Desperate to lower their financial risk profile and drastically shrink the size of that emergency bill, executives made a highly controversial decision to cut off the trading volume. On the morning of January 28th, the app completely disabled
that the institutional guys can get in there and buy, and these retail armies can't.
The buy button for GameStop and other volatile stocks, while leaving the sell button functional. Retail investors watched in absolute horror and fury as their positions artificially collapsed in value, frozen out of the market. At the same time, institutional hedge funds were still permitted to freely trade and cover their short positions. Under oath, Robinhood executives blamed this on the clearinghouses. But to the millions of everyday day traders watching on their phones, it just so happened that Citadel Securities, who was Robinhood's #1 customer, was heavily involved in the backroom deals. Citadel's hedge fund division had just invested $2 billion emergency cash into another hedge fund, Melvin Capital, who was bleeding billions on their GameStop shorts. If GameStop's price kept skyrocketing, Melvin would go bankrupt, and Citadel's $2 billion investment would vanish. Simultaneously, Citadel Securities was acting as the primary market maker, executing trades for Robinhood. When you look at the money trail, it is not difficult to see the massive conflict of interest. The exact millisecond Robinhood blocked the buy button, the retail demand stopped, the stock price tanked, Melvin's losses were capped, and Citadel's billions were protected. The illusion of a platform built to empower the little guy dissolved in a matter of hours, sparking high-profile bipartisan congressional investigations and intense public outrage. The Financial Industry Regulatory Authority fined Robinhood $70 million over neglecting its duty to supervise trades, maintain its own technology, and protect its customers. The fine was the largest in FINRA's history, but the user backlash was more devastating. Feeling entirely betrayed by an app that had weaponized anti-establishment marketing only to shut off the market when the house started losing, traders turned on the platform en masse.
Headlines passed that Robinhood users have now sued the company. At the same time,
millions of users coordinated a massive digital exodus, transferring their entire portfolios to rival brokerages and orchestrating a fierce viral campaign that vowed a lifelong boycott of the app. Across social platforms, a generation of retail investors swore never to trust their capital with the business again. The zero-fee framework ultimately forced the entire financial industry to eliminate front-end commissions just to stay competitive in the digital age. Yet, as this trajectory proves, the financial system rarely leaves money on the table without finding an alternative way to collect. The lifelong boycott serves as a permanent monument to a bitter lesson learned by millions of everyday traders. If a financial transaction appears completely free, the true cost hasn't been eliminated. It is simply hidden deeper in the machine.